Welcome to TheoTrade. This is Don Kaufman. Here we are. It's January 17th, 2018. You are watching the Theo Night video. Well, the theme today is a market of extremes. First and foremost, a quick recap of some of the action inside of today's marketplace, which still has about 20 minutes left in the trading day. Nevertheless, we're looking at the S&P futures exploding once again, up 25 handles right now. Again, with 20 minutes to go in the trading session, they're just off all-time highs, hitting 2809. Nasdaq is right there with it. The Russell is a little bit lackluster today, but when I talk about, again, a market of extremes, once again, we're seeing the S&Ps explode to the upside. The volatility is barely off, but the extremes that we're seeing over here happen to be seen everywhere, from everything from like technology. I mean, you're getting Microsoft, okay, with nothing really going on, up about 2%, okay? We're seeing Apple also bid, yet Netflix is getting whacked back on some news over there. Conversely, we have seen Amazon down substantially in early trade over here, all the way down to $12.80 before turning around and ripping back to the upside by $20. It's a market of, again, complete extremes. On the other side of the spectrum here, if you take a look at something like the XLF, this thing is up again 1%. But at the same time, one of its key components in the financials is down over 2%. Not to mention Bank of America not faring too badly after earnings, but Bank of America was all the way down to $30 and change before having a, get this, $1 rally off the bottom today. Again, a market of extremes. And in a market of extremes, I'm going to explain briefly, well, a fairly extreme strategy that many of you can partake in. Now, the strategy that I'm going to explain, I'm going to give you kind of the crash course of the strategy right here, right now. For those of you that have access to the TheoTrade site, today's coaching session was specifically on the strategy I am about to display to you. So again, for those of you that have access to the site, hop on there for more in-depth session on what I kind of call a strategy of extremes. First and foremost, you're looking at a market exploding to the upside, okay? Neither here nor there. What we're going to do is something I've been talking about now for months, and that is you want to participate in the upside, but you don't want to go out there and put your entire neck on the line, right? What does that mean? I don't want to go out there and buy a $280 product, which is the spiders, right? Because what can ultimately happen to me in this time frame over here? Hey, listen, I could buy the spiders. I could wake up one morning just as easily as, again, we're up right now 25 points in the S&Ps. We could be down 30, 40, 50, okay, 70 S&P points overnight. And again, that's a huge amount of risk. Rather than take that risk, I'm actually going to use a short duration, no greater than 1 week out in time, and I'm going to key into right around an 85 delta option. In this particular circumstance, we're going to use the 275 calls. Now, I think a relative fair price for the 275 calls happens to be about $5.30. I'm going to take that trade, I'm going to right click on it, and I'm just going to dump it over to the Analyze tab, okay? What you'll see in this particular circumstance here on the analysis is, hey, listen, if the market goes up, I'm going to make some decent money. If the market crashes, burns, dies, I can't lose more than $5.30. Now, $5.30 can still be construed as, well, quite a bit of risk. However, I want you to recognize, as I look at this, and I only have $5.30, this is still giving me, okay, almost an 85 delta, which is 85 cents for every $1 move in the spiders. That's a lot of bang for your buck, but you're still mitigating your risk to $5.30, right? So I participate in huge upside potential. I mean, do you realize how far the spiders have gone in just the last, couple of weeks? We can talk about just since the beginning of the year. The spiders are up 4% since the beginning of the year. Dollar for dollar, okay? And we'll just take this into context, dollar for dollar, that's looking at the spiders at 268. They're now trading 280. That's a $12 move, okay? here's an option that'll give you 1 week. Now you're going to question, like, why are you just going out a week? Because I don't want, all right, to put my neck on the line. If I go out over here and somebody goes, well, I want to be long, but I want to be long for the next 30 days. Yeah, but for 30 days to use an 85 delta option, you gotta put like what, $16 at risk. What are you, crazy? Like, listen, just go out there, use a week. And if it works for a week, take the option, roll it further out in time. Now, that's only part of the logic of this. The second portion of the logic is, hey, I think that we can all agree that we're in what I call a market of extremes, or what I also tend to call Fed-fueled insanity, all right? And when you're in Fed-fueled insanity, hey, one of these days we're going to wake up and things are not going to be, all right, as rosy as you would expect them to be and have been in many of the recent trading sessions. As such, I'm going to build what is termed a risk twist spread. Now, this is something we've actually, covered in a lot of previous sessions, okay? But I'm just quickly going to build a risk twist spread. I'm going to take the risk twist spread. I'm going to drop it over to the analysis tab, and I want you to see what I've actually done. In the short duration, I'm net long, okay? In the long duration, what am I? Massively short, okay? And I've created a trade that will explode to the upside should the market fall. And again, this is what the risk graph looks like kind of in the short duration. Now, this is where I said, if you want some more, detail, some more explanation on this, I cover this in great depth in today's coaching session found on the TheoTrade site. Again, it's all about, evaluating your options in a marketplace that is absolutely extreme. But here, I kind of call this strategy a little bit of have your cake and eat it too. In the short duration, okay, we're net long, right? And again, I want to zoom in over here real briefly so you can see, okay, the break even. The market right now is trading 279.69. I mean, that's live right now. And you can see, and I just froze the screen, that little dashed line, that's my break even. So what I want you to recognize is if the market trickles the slightest bit, okay, slightest bit to the upside over here, you're going to be profitable. Any downside movement, now a small downside move is going to have some degree of risk. However, what I want you to recognize now is any downward momentum in the market is going to bring volatility higher. So let me just adjust volatility up just 5%. You can see, all right, the P&L over here is beautiful, okay? Take the trades, play around with them a little bit for yourself. But I do kind of caution you, with these strategies, please know what you're doing. Know the criteria that is embedded in the risk twist spread. Again, know the design of this trade is, hey, we're bullish until we're not. And when the market finally does crack and turn and breaks to the downside, we'll have a nice, comfort over here in knowing that we have this 275, 267, 265 risk twist spread in play. And ultimately, we could have some spectacular downside opportunity should the market fall eventually flat on its face. That, people, is a strategy designed, again, for what I term as market extremes. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.